That's their reason to exist. So they're always going to have a bias towards controlling inflation. So the inflationary effects and like the lingering impacts, like the longer this goes, then you get this sort of spiral where oil prices start driving all consumer prices higher. And then people see prices at the grocery store and the gas pump and everywhere else rising. And they ask their employer, like, I need a bigger wage increase this year. You just get this really difficult spiral that then the bank has to be really aggressive to try and break. And we saw this. This is exactly what happened during COVID. And so the question for the Bank of Canada is they were pretty roundly criticized for acting too late during COVID. They waited about a year to start raising rates when inflation was very clearly rising. That's pretty fresh in their minds. Maybe they want to get some credibility back by being more aggressive this time around and raising rates in the United States, which is also super important for what happens to bond yields here. The Fed has gone from an assumption by markets that they were going to be cutting rates once Kevin Warsh came in, he was sworn in today, to now expecting that they might actually have to raise rates. So all of that, means like even if the Bank of Canada isn't going to raise rates this year, even if they keep rates level, we've seen 5-year bond yields jump significantly. I mean, they touched like 3.4 this week because of expectations that central bankers in both the US and Canada might have to raise rates to fight this inflation. So a lot of what's in the 5-year bond yield right now is pure expectations about monetary policy. You can kind of look at any bond yield and break it into two parts. One is, what do markets expect, the central bank's going to do? And the other part is like a risk premium. And so part of what we've seen is higher risk, and that's about, I think, 20, 30 basis points if you look at the Bank of Canada's data. And a big part of it, though, is just expectations that banks have to raise rates. Super long-winded answer to your question. And it's like, essentially, I don't know. I don't think the Bank of Canada will raise rates because the labor market is really weak. And the economy is a little bit weaker than I think GDP growth is suggesting. But it kind of doesn't matter because 5-year fixed rates are already rising significantly just because of expectations. Fixed rates could come down if this gets settled tomorrow and all that expectations for rising rates gets pulled out of bond yields and we're back to where we were pre-war. But if you take a variable rate, you're also risking that markets are right and the Bank of Canada is going to raise rates at least twice this year. So that's why a lot of people are taking a 3-year lately because it's still a pretty decent rate and you can kind of bypass all this uncertainty.
Something you said at the beginning there, so it seems like inflation kind of supersedes GDP in terms of like what Bank of Canada is focusing on because they're in such a difficult position, right? It's like the economy sucks, so you have to lower the rates. But if inflation starts to run away again, like it doesn't matter what our economy is doing, like inflation's just going to level anyone.
Ultimately, their mandate is to keep inflation at 2% over the medium term. That's their reason to exist. So they're always going to have a bias towards controlling inflation.